I found this analysis looking at bank closures. And so if you look at the 80s, there's a massive spike to the point where you had almost 250, 300 banks in like 87 close, right? But I guess what you're kind of positing is if we were to have a lot of bank closures, right, does this thing spiral out of control? I don't know. But or are some bank closures needed? And I guess what's also, I didn't even really know this, that there's still more banks closed in the Great Depression. I guess this is saying almost 4,000 banks closed relative to about 1,600 banks closed kind of in that Volcker period of time. So still a lot less than if we go back almost 100 years, but compared to today, just seems like, I don't know, if we have a more fragile economy because we've printed so much money and then the reverberations are just so much greater because of the money printing. That like the concept of QE didn't exist 40 years ago.
Yeah, well, first of all, I worked as the chief economist, the U.S. Senate Banking Committee, from essentially 1986 to end of 1989 under William Proxmire. That was the 87 stock market crash, and that was what's called the savings and loan crisis. Many of the financial institutions that collapsed at that time were part of the savings and loan crisis. There were questions of regulatory appropriateness around savings and loans. There were a lot of savings and loans that were supported by the FDIC, but the Federal Savings and Loan FSLIC, the analog to the FDIC, but nothing on the asset side was being monitored or restricted. And when they spiraled out of control, I was part of the design of William Seidman that ran the FDIC and Volcker and then his successors at the Fed. We worked on essentially how to not make that mistake again. And the savings and loan bailout was, I can't remember, $150 billion of budget, but the institutions that none of them were what you might call too big to fail. There were elements, you can go back to what's called the Keating 5 episode. Lincoln Savings from Arizona, Charles Keating, was active in trying to persuade, I believe the Keating 5 were 5 senators, to lay off the regulation of the asset side of savings and loans. In the Keating 5 episode, took, put the zoom lens on that dimension. Maybe we didn't go far enough. And so years later, the Keating 5 episode is like 1988 to 1990. So you're talking almost 20 years later, those same kind of things that we saw, and Charles Keating's not alone. It's the, what you might call parable, the highlight reel of that time. But we started seeing that at the too big to fail banks in 2006, 7, and 8. And I guess it might be that this episode, if it doesn't turn into a broad-based run, is closer to the savings and loan structure than it is to the too big to fail structure. I mean, a lot of people now feel that the too big to fail banks are going to be the beneficiaries, because when there's fear of default, everybody will shift their deposits in under that umbrella because they believe they will be guaranteed.
Yeah, Chase just got $15 billion in fresh deposits in a week, and I think Bank of America also. And
the ones in trouble are the regional banks or the niche banks like an SVB. It seems like the ones that are winning, somewhat ironically, given that some of the the deregulation that was passed to in I think it was 5 years ago now or 6 years ago now was intended to help the regional banks and the smaller guys. And now it's put them at risk, which has swung the pendulum back in the other direction.